Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ryan McCormack, Factor and Core Equity Strategist at Invesco, for an update on weekly performance in the Nasdaq 100. We'll also take a look and see what the Fed funds rate is pricing in for rate hikes for the remainder of the year and beyond. Ryan, it's great to see you as always. Welcome back to Trade Talks. And let's discuss what you saw over the past week in terms of Nasdaq 100 performance.
Hey, Jill, it's great to be back. And another week of NASDAQ 100 outperformance. We saw QQQM up 1.88% and QQQ up 1.87%, outperforming the S&P 500 up around 92 basis points and the S&P 500 value up around 89 basis points. But much of the week's focus was around the debt ceiling debate and whether or not we could get a deal done before X Day, estimated to be somewhere around next Thursday, June 1st. It was interesting. Thursday, we saw the big move of the week where QQQ advanced by almost 2%. And that was after Speaker Kevin McCarthy had said that the House could see a vote on the debt ceiling deal at some point early this week. Here we are on Wednesday, still no deal as of yet. So I think the market is certainly in wait and see mode.
It certainly is. Let's talk about the sectors that were leading the way for the week.
Yeah, growth oriented led the charge. Within QQQ, we saw all but one sector outperform their counterpart in SPY, a proxy for the S&P 500. But in terms of specifics, the biggest relative contributors was really driven by overweights the technology, consumer discretionary, and communication services sector. Healthcare also was a pretty big contributor to relative outperformance, despite being one of only two sectors in the red for the week. We saw outperformance in the sector within QQQ relative to healthcare and SPY, and its underweight allocation helped on a relative basis. And then just in terms of individual companies, tonight we have NVIDIA reporting after the bell. A lot of focus there, widely expected to report a decline in gaming chips. But the focus will continue to be on data centers and the growth that they've seen in that segment, along with any other commentary on AI partnerships, opportunities, and enhanced capabilities.
Who wants to take the over-under on that? So, Ryan, let's take a look at the Fed funds rate here for a moment, because it feels like the market is pricing in something else. It wants something else. And as far as I'm aware, the Fed has not changed their course or even signaled anything that sounds like a rate cut.
Not really. And, the Fed funds futures look really different today than they did 3 weeks ago, like right after the last meeting. And following that last FOMC meeting, the market had all but priced in a pause in rates, and then seeing a 56% chance of a rate cut by July. Fast forward to today, we now see a 59% chance of a rate hike in July. So, you're right. We've seen a very marked difference in what the market is anticipating from the Fed. And today we saw the release of the minutes from the May meeting. And with that, I think the major theme was this notion of optionality, right? That participants and those close to this need to kind of remain very data dependent and have the ability to move in one direction or the other, depending on what the market dictates. You saw some commentary around maybe some frustration around the pace of a reduction in inflation, right? Moving very slowly towards the Fed's ultimate goal of 2%. And with that, there's sort of this notion that maybe there needs to be a continued firming, a continued tightening of economic conditions. Within there, they did note that there is concern around the debt ceiling not coming to a conclusion, or the debt ceiling not coming to a deal, which could certainly disrupt the financial system and further weaken the economy. Within it, it's sort of this notion of those that think that the fight against inflation is moving too slowly. Those on the other side, kind of more in the dovish camp, that say, hey, we need to wait and see and be patient to look and ascertain the effects of all the policy tightening that we've undergone here over the past year and change. And then in the face of all this, you have the labor market, you have inflation, you have the economy remaining robust to the surprise of many. I'll just add, today you had Fed Governor Christopher Waller, talking, with some pretty hawkish commentary saying, he doesn't support stopping rate hikes until we really get the evidence that inflation is moving towards 2%. But, of course, as we've seen over the past number of months, he did finish his comments with, we do need to be data dependent over the next 3 weeks before the June meeting.
Well, Ryan, investors have given the Fed a hard time, and all the talking heads have given them a hard time that they moved way too quick in terms of tightening. Now, there's a couple things here. We were so used to the system flush with liquidity, zero interest rates. If they gave them such a hard time with rates going up so quick as they did, the same thing in theory could happen if they change course too quickly, where perhaps inflation would get out of control again, or there's just other scenarios if they were to pivot too quickly and take the debt ceiling out of it. But if they pivot too quickly, I think that could be concerning as well if history proves as a guide.
Of course, right? I mean, I think everybody loves to be the armchair quarterback, right? And sort of look back and point fingers. But you're absolutely right. I mean, if they were to take the foot off the proverbial gas too quickly, and you saw sort of this reacceleration of inflation, yeah, that would certainly be a risk to the market, and certainly would cause some disruption amongst how they would need to address that policy going forward, and again would certainly argue for more aggressive Fed action in the face of that.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.